Most millionaires didn't get rich by day trading or chasing meme stocks. They built wealth slowly and steadily, and one of the simplest tools they used was index funds. If you've ever wondered, what exactly are index funds? Why are they so popular? And how do you actually invest in them? Then stick around because I'm going to break it all down. An index fund is basically a type of mutual fund or exchange-traded fund, ETF, that's designed to track the performance of a specific market index. An index is just a list of companies grouped together to represent a slice of the market. For example, the S&P 500 index tracks the 500 largest publicly traded companies in the US. The Nasdaq 100 tracks the 100 biggest tech-heavy companies. The Russell 2000 tracks 2,000 small-cap companies. So if you buy an S&P 500 index fund, you're not buying 500 individual stocks yourself. You're buying one fund that automatically owns tiny pieces of all 500. That's instant diversification without the hassle. Not all index funds are the same. There are two main categories. Mutual fund index funds. You buy them directly from a brokerage like Vanguard or Fidelity, but they usually trade only once per day. ETF index funds. These trade like stocks, so you can buy and sell them anytime during the trading day. Examples: SPY, VOO, QQQ. Both serve the same purpose. They track an index, but ETFs are often cheaper and more flexible for beginners. Here's why index funds are a game changer. Diversification. Instead of putting all your money in one company, you spread it across hundreds or even thousands. That reduces risk. Example: if you own Tesla stock and it crashes 20%, your portfolio takes a hit. But if Tesla is just one out of 500 companies in your S&P 500 index fund, the impact is tiny. Low fees. Actively managed funds charge 1–2% per year. Index funds often charge as little as 0.03%. That may sound small, but over 30 years, high fees could cost you hundreds of thousands of dollars. Proven performance. Studies show that most professional fund managers actually lose to index funds over the long run. From 2000 to 2020, about 90% of actively managed large-cap funds underperformed the S&P 500. Compounding growth. The US stock market has returned about 8–10% annually on average. That means your money roughly doubles every 7–9 years if you keep investing. $10,000 invested in the S&P 500 in 1990 would be worth over $200,000 today. Now they're not perfect. Market risk. If the whole market crashes, index funds will go down too. In 2008, the S&P 500 dropped more than 35%. No beat the market potential. Index funds don't try to outperform, they just follow the market. If you're hoping for huge short-term gains, this isn't it. Patience required. Index funds are a long-term play. If you panic and sell during downturns, you lose the benefit. Getting started is easier than most people think. Open a brokerage account. Vanguard, Fidelity, Schwab, or even apps like Robinhood or Webull. Choose your index fund: S&P 500, VOO, SPY, FXAI, Total Market, VTI, International, VXUS, Tech, QQQ. Set up automatic contributions. Even $100 a month adds up big over decades. Hold long term. Don't try to time the market. Just keep adding consistently. Let's run some numbers. If you invested $300 per month into an S&P 500 index fund for 30 years, assuming an average 8% return, you'd end up with around $440,000. Double that to $600 per month? That's almost $900,000. This is why people say, time in the market beats timing the market. So, to sum it up, index funds are simple baskets of stocks that track the market. They're cheap, diversified, and historically reliable. They're not get-rich-quick, but they are one of the easiest ways to build real wealth over time. If you're just starting your investing journey, index funds are probably the single best place to begin. Now I want to hear from you. Do you already invest in index funds, or are you still thinking about it? Drop your answer in the comments. And if you want me to make a video comparing the best index funds to buy right now, let me know. Don't forget to like and subscribe for more investing breakdowns, and I'll see you in the next one.